Hey everyone, hope you're having a good day. My name's Andy. The channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, financial topics, and/or commodities. That's where I think the value is, and I'll talk about all of those topics, sprinkle in what I want, and we'll go through what people are sharing on social media. So let's dive in there and let's see what's going on with what is being shared. So at finding_finance, if you want to find me, and finding-value.com, that's where I do a lot of training. A lot of people are liking the trainings I'm doing at the beginning of the question and answer sessions, or not really training, but maybe market information that I follow. And if you want to sign up, we still have the coupon code LEAP, LEAP. You can put that in the coupon code and get a discount. The bigger discounts on the yearly membership versus the monthly membership, where you only get 50% off for the first month. All right, so coming on down, Christine says, and I know she's an oil person, so I somewhat follow some of her posts. She says, when did vehicle maintenance get so expensive? My F-150 is at 75,000 miles. I'm getting all the fluids, spark plugs, and rear shocks changed, and it's nearly $3,500. Of course, after you're told you need something, you don't want to put it off because you'll no longer have a peace of mind behind the wheel. At least that's how I'm built. I One of the things that has helped me be so successful at saving money is I've done all of my own maintenance. Spark plugs are a breeze. Doing your oil changes easy. Doing the rear shocks in your car is a piece of cake if you are doing this. Even wheel bearings and all that stuff, as long as you have some tools and you can bring in something to get pressed out. We press it out ourselves, me and a buddy who's got a press. You can save dramatic money. So, what would this cost me if I were to do this? Just yesterday, I did an oil change on the RX-7 and I flushed the coolant. I flushed the coolant in that car about once every 2 to 3 years. That's how often I do it. The coolant you can buy at Walmart for about $8 or $9. And maybe it's $10 now. It's gone up, but $8 or $9, and you want to pre-mix it with distilled water. You don't want to put regular tap water because it'll rust some of the stuff inside the engine. So you want distilled water, and you want $9 of pure, not 50/50, just the pure coolant mix. Spark plugs, depending on what spark plugs you buy, you can buy spark plugs ranging from, I'd say, about $5 or $6 a plug, like a pretty good plug, up to maybe 20, $30 a plug if you have a special racing plug. So that's what they cost per plug. If that's 8 plugs and they're $10 each, that's $80. So you're in about $100 worth of parts. Rear shocks, at least on my Aveo, I just did those not too long ago. They were like $25 to $40 a shock. And then I put them in myself. So, I mean, you might be looking at $150 to $200 worth of parts. Most of this is probably labor. That's what's going down. One of the spots that I go to is I shop online and I literally buy this stuff for cheap on some of these websites. And guys, if you can do your own maintenance, you can save boku bucks, and you can buy cars that people offload who don't know how to fix them and get really good deals, fix them, and then resell them if you really want to put in the work. So a part of me saving as much money as I have is due to me doing my own maintenance and changing all these things in the house myself. I just do everything myself. I know some people have expressed interest in me um, starting another channel and then doing some of this stuff. It's really not that hard. I can even show you the websites I go to, the parts I buy, what I think's good, what I think's bad, and it's really not that hard. And you can save. thousands of dollars on maintenance, and to me it's really easy. But I've already done this stuff, so. Someone tell the oil markets Chinese apparent petroleum demand grew nearly 2 million barrels per day year over year in 2023, the strongest annual demand growth print of any country in oil industry's history. Benefited from 2022 COVID base effects, first negative year, but still remains staggering. So, definitely not a demand problem, and China is ramping back up massively for oil demand. HZ puts in end of an era, lost decade coming for tech. I agree. Now, you know what occurs during these lost decades? Big commodity bull markets is what occurs. That is what's coming. And that's what's going to occur, I think, for the NASDAQ. It's going to, obviously, these things cycle back and forth. Some assets come into favor. It's in favor, the NASDAQ here. And I'm not saying that this is going to be a top. We could go a little bit higher, but I think eventually it will fall out of favor and when the commodity cycle kicks off. We're just early. We're early in the commodity cycle. We're waiting for all this stuff to rotate, and that's part of the game. Here's a heads up. The lower 48 gas production is starting to decline. However, a big part of the decline over the weekend resulted from TETCO restricting capacity allocations. So this is the lower 48 production for billion cubic feet per day, and you can see we're dropping on back. And this will help the supply-demand balance of natural gas and hopefully slow down the injections into inventory with our warm weather at the moment. What does Uncle Jamie know? This is Jamie Dimon of JP Morgan. He's the CEO. You can see he's got really well-timed buy points in January of 09, another pretty well-timed buy point, and a very well-timed buy point there. And he's got a sell point up here where he's offloading some shares at what could be a very opportune time. So that's Jamie selling now, and you can see that how well he timed his purchases. That is exactly what we are trying to do. We want to cost average in when the stock is down, much like Jamie Dimon's doing here, and then sell when that cycle is up high. And that's probably what he's doing, or maybe he's just living life, who knows, and as he's getting a little bit older. But yeah, that's what we strive to do as well on the website and myself. Scrolling on down, Christine again, she says, over the next 3 years, India will add electricity demand roughly equivalent to the current consumption of the UK. Coal is 70% of the electricity mix. So India is going to add a bunch of electricity demand, and a lot of it is going to come from coal. And I don't think people are necessarily realizing how much coal is going to be installed in India and China. And it's going to be interesting to see shipping all of this stuff around and also producing that amount of coal. It's going to be ridiculous. We've got in the US markets alone, demand measured by power consumption to reflect the number of servers a data center can house is expected to reach 35 gigawatts by 2030, up from 17 gigawatts in 2022, says McKinsey. Who will keep the power running for these picks and shovels of the AI revolution? That's a gigantic gain in electricity consumption. And if we've got electric vehicles going up at the same time, this power grid's looking a little weak. Who's going to generate all this electricity? Where's it going to come from? My guess, coal and natural gas worldwide is where a big chunk of it's going to come from. Nuclear, it's got some growth over in China and maybe India, but it's not really a growth factor in America at this moment. I think it will be out in the future. It's just not at this moment. So I think natural gas is going to be the lion's share of the winner of this increased electricity demand over time. they say they're going to put solar, but natural gas is what backs solar. It's the if solar doesn't work, there we are pumping natural gas through. Here's President Biden will withdraw oil from SPR if WTI reaches $90 before the elections. Secretary Granholm will brag about buying oil at 77 a barrel and selling it at 90. Watch out. And that's probably a high likelihood that we could see Strategic Petroleum Reserve releases if we hit $90, which I think we probably will. And I bet you they're going to release oil from the Strategic Petroleum Reserve. This is admitting that we've got a problem on our hands in oil. So that doesn't mean it is bearish. I would say that it is extremely bullish. And what it does is it's going to keep the oil stocks down longer to buy. And then when this election's done, I don't know what's going to happen in 2025. It's going to be game on like Donkey Kong, baby. Oil's going to be, it's going to be tight. According to Gas Buddy data, weekly, Sunday through Saturday, U.S. gasoline demand jumped 2.3% from the prior week and was 3.6% above the 4-week average. Modeled gasoline demand data will be available tomorrow morning. So we're seeing stronger demand also for gasoline in the United States. Josh says the effect of underinvestment in long cycle exploration and delineation is insufficient production, as JP Morgan showed in 2023. We see a 1.1 million barrel per day supply deficit emerging in 2025, widening to 7.1 million barrels per day in 2030 is the estimate, driving upside risks to oil prices. So what do we want to see? How do we want to play this thing? This, I think, is coming. And this gap here, guys, is going to impact the rest of the investments out in this world. This here is, it's like a paradigm shift in the markets is going to occur. And I don't think everybody understands the full ramifications of this gap that could potentially be coming in oil and what those impacts will be to other sectors. As price goes up, I don't know if there's going to be a supply response. So price is going to have to go to a level that is literally going to destroy demand and stay there for a long time. We could see a recession when it first goes up. We could see a recession and a cleansing of the system, and then we're going to try to grow again, and then we're going to peak out again and have to kill demand again. And this is where what was his name? I think it was Colin Campbell. He was an oil geologist, and he said once you hit peak and you start to peak out, and you basically have GDP that can't grow, you're going to get like these rolling high, oil price spikes, and then they'll crash the market. It'll spike back up again, crash the market, and it'll do that continually. That's what his opinion was, and that's probably right. But looking at the future and getting positioned where oil is today, I think is one heck of an opportunity. And what I think will eventually emerge is the realization that oil at $75 is probably the most undervalued commodity in the market. Number one, it's the number one commodity in terms of its uses. And number two, if the expenses go way up of oil, we're going to find out if there's any sort of substitutes for it, or if we're going to take the route of basically trying to make things a lot more efficient. Lighter weight vehicles. Maybe we aren't driving cars, we're driving like mopeds. Like we really got to start to save our oil use and save it for things that we need to use it for, like farming or whatever else. But this gap, I think, will change what the world looks like. And it's about to change here very soon, probably starting in 2024, 2025, because the markets are forward looking. And if this gap does occur, I think interest rates are going to go way up. And at some point, it'll probably cause a recession at some point. This is absolutely nuts. Nvidia is now worth more than the GDP of every country except these 11. So USA, China, Germany, Japan, India, UK, France, Italy, Brazil, Canada, and Mexico. And then we've got Nvidia at 1.97 trillion market cap versus those GDPs. So that's kind of where that is. It's bigger than Russia. Nice. Stephen Stapsikninsky. Wow, nice. He says India increased its peak power demand outlook again as consumption keeps outpacing expectation. The government now expects peak demand to rise as high as 384 gigawatts in 2031-32. Rising power needs are pushing India to expand its fleet of coal plants. So coal is not dead, guys. It is not dead by any means. Now, here's something to think about. If this does occur, who's going to make up this difference? Is it going to be coal? Is it going to be fossil fuels like natural gas? What's going to make this difference up? Because people are going to panic, and there's going to be a mad rush to something. And that's, are we going to do ammonia? Are we going to do maybe something like making diesel out of coal, doing some sort of coal liquefaction deal, liquefying coal to some degree? But here's India's rising electricity demand in terms of a chart. You can see how this thing is ramping up dramatically. And again, I think this is going to go way up. Same with artificial intelligence. We could see India and China in their S curves, and then artificial intelligence also send electricity demand to the moon. I mean, this could get real interesting here. Here's copper. Uselink says copper has broken its 2-year long golden resistance. It's now consolidating within a blue bull flag. If copper breaks out of that flag and confirms above $4, that's massively bullish. So yeah, maybe we can get a big move with. We saw the manufacturing index was starting to turn higher, and I think I've got that below a little bit here. So that could be the case with copper breaking. Here comes lumber futures, and I know some people like to watch lumber. We're in the bullish regime, is what he's got. Basically, a downtrend that's broken, a retest, and probably moving on up. And there we are at 588, trying to break that 588 mark, and we've got higher lows coming up on the right-hand side here. So lumber doesn't look too bad, and we're probably going to go into a home building spree where we build a lot more new homes. See expansion phase of real estate. U.S. dry nat gas production is declining. It is currently estimated at 103 billion cubic feet per day. That is falling, and I already had another chart up above. My February newsletter is out now and focuses on signs of emerging economic reacceleration amid the fiscal dominance that is occurring. So we are seeing manufacturing new orders index coming back up. Same with the manufacturing PMI. So maybe we can get above that 50 mark and start growing again. That's going to be positive for commodities for sure. So maybe this is going to be the next bull market here starting in commodities, and we'll see it probably across the board for commodities. And this is what I was referring to for copper potentially breaking out. This is one of the drivers here. The current AI bubble is bigger than the 1990s tech bubble, Apollo Academy says. 90, 95, you can see, and then we've got a big bubble here in 2024 for the top 10 median PE ratio. And you can see 90, 90, 95, 2000, that the PE ratio is lower back then than what it is today. So you could say that the bubble is bigger than the 1990s tech bubble today based on valuations. Josh Young says global investment and energy consumption of renewable power, wind and solar and fossil fuels from 2015 until 2020. And what you're looking at here is this is the investment that people made in fossil fuels and in wind and solar. And then the impact of this investment is over here in terms of energy consumption. So they spent 5.7 trillion on wind and solar, and they got back 247. Looks like this is joules. I don't know if it's some unit of measure or something joules of energy consumption. Fossil fuels, they put 8.5 trillion and netted 3,842, which is a much better investment in terms of dollars per energy unit of energy. So fossil fuels is still the thing that we probably want to invest in, and wind and solar is something that we should abandon, in my opinion. Nvidia is way far away from the green circle, but other assets that are unloved and off the radar are right at the green circle. And that is exactly what we are buying on our website. Our companies that are coming out of basing stage one periods and exiting the stage one and doing a retest. That is considered the ideal buy point in a lot of technical analysis. That is where a lot of our companies are in a lot of these sectors that we are buying. Then you ride it on up over the next decade or so, and you sell it at stage three when it's peaking out. No one's going to buy the perfect bottom. No one's going to sell at the perfect top. Very difficult to do that. But what we're trying to do is capture the move as much as we can of stage two. That's what we're trying to do. That is the strategy that we are deploying. Some of the companies are here, and then some of the laggards could be down here. So I also buy some of the laggards that are still in stage one if the leaders in the sector have broken out and are entering stage two. So yes, I own the leaders. Those would be my first purchases. And then some of the laggards you could also purchase. Maybe they're smaller cap companies. Maybe they are service companies of service companies. Whatever the reason is, some of them can still be lagging and be great opportunities to buy before they start entering their stage two move. Seasonally, March demonstrates the strongest month-over-month price increase for crude oil. Let's see if that's the case in 2024. And this is the 24-year crude oil price seasonality. You can see that the strongest difference occurs between February and March. And that's where we're entering. So historically, the past 24 years, the biggest moves have occurred now in crude oil price seasonality. And I think that's the case based off of the cyclicality of demand, the driving season, when people go on vacation. And that seasonality peaks in July. China flights stats. Look at the flights here, guys. This thing's like off the page compared to these other years before it. 19, 20, 21, 22, 23 are way below 2024 in terms of China active flights, the past 7-day average. Then you can see miles, the 7-day average, way up there in relationship to previous years. So we're setting records here, baby. It's looking good for demand for China. Shortage of oil tankers. So there's a shortage of oil tankers at hand as Red Sea attacks divert trade. Large crude carrier deliveries at lowest in almost 40 years. Cargo diversion and disruptions are adding to tanker demand. We are also playing this here because of the valuations, and the charts look excellent. Shipping in general, dry bulk and tankers, have opportunities. You know what? They're buying back shares and they are paying dividends. That's exactly what I look for investments. The boring stuff that people aren't looking at. And you know where a lot of them are at? They are at stage two right here. That's where they're located. Coming on down. How to lose good employees. I want to give an opinion on this, guys. So this is what she says. Give them work that doesn't matter with no room to grow, no clear expectations, and surround them with low performers. How to hire and retain A players. Um, my company would do stuff like this. They would buy stuff like pizza or bagels. They would do that all the time. So here's my opinion. This is what they have. This is our list of 13 values. It says people who say it cannot be done should not interrupt those who are doing it. Be a great human. Do what's right even when it hurts. None of this matters to me. I mean, I worked at all these places. Let me tell you my opinions on this. So, if you want good employees and you want to keep them and retain them, it's much like playing sports. And I played sports with very, very competitive people. I played with about 5 or 6 ex-pro hockey players. I played with some professional baseball players as I grew up. I played on these all-star teams in Minnesota, uh, and whatnot. So did my brother. And so the way to retain good players, the way to retain good employees, this is what I'll say. There's a couple of things that I would want as an employee. If I'm putting in work and I think that I'm doing a good job and I'm hitting those clear expectations, my expectation is if I meet or exceed the expectations, if I'm adding more value to the company, and I'm talking putting in new product lines, uh, doing things that are above and beyond and positively impacting the culture, I expect to get paid well. And if they don't deliver on the pay, then they don't value me. That's what it is, period. And when I go through these really competitive teams, if you don't perform, you are off the team. You will not be asked back to be on the team if you have poor performance. So surrounding good employees with low performers, it may or may not impact them. That's I agree. But here's another thing: the culture that is set, the conditions that the employee works under, is also a huge deal. So if you're a high level employee, and let's say you're really good at doing things, you don't want to deal with a bunch of BS. A lot of these companies that are really big, it's like 90% BS, 10% work. So you're just dealing with a bunch of crap. I would say the majority of upper managers are garbage, absolute garbage. And all they do is they try to put these Excel spreadsheets together, create these graphs and charts and presentations, and try to present to other people. There's no value really added there. The value isn't added by putting together charts and graphs so someone else can understand if we are doing well or not. The value is getting all of the BS out of the company, leaning it out, and then focusing on the things that do add value in the company. But a lot of these companies, they're just a bunch of BS. So if you surround good employees that don't want to deal with the BS, they'll eventually leave. And the more woke a company gets too, and if they don't want to put up with it, they just leave. They will continually put people, the people that work there, if you're not getting, if you don't think that you're getting rewarded for your hard efforts that are above the expectations, you either leave the company or you figure that out and you become the lowest value employee because now the name of the game is switched. How can I get paid the same amount of merit increases that I was getting with and do the least amount of work? Because I mean that's really what they force you to do. You either do good work and get paid for it. If you do good work and you don't get paid and you want to stay at the company, then you figure out how do you do the least amount of work and still get paid the most amount of money. That's what you do as an engineer. You figure out how do you maximize your dollars per hour. And that's kind of the way that I look at it. And if you're at a crappy company, what they turn you into. And there's a lot of crappy companies, guys. They're all over the place. Even with equity soaring, the 10-year Treasury remains in a high time frame uptrend. We will see new highs in 2024 in terms of yields. I agree, and that's going to be positive oil most likely. But that's where I'm going to end it, guys. That's where I'll have it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We just had a great question and answer session on Sunday, which was 2 days ago, I guess now. And that is all posted, and I posted all the information onto the website if you guys are interested in viewing it. So it's all up there. But that's what I've got for today. Hopefully you guys are killing it. We'll catch you next time. This is Finding Value.